Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. A couple of years ago, I had done a YouTube video on ITC. I had argued that ITC looked like a better investment than HUL, Hindustan Unilever Limited, from a 2 to 3 year perspective. My logic was simple. HUL may be a better quality stock, but ITC looked like a better investment at the time. In fact, I'd like to quote Howard Marks here. There is no asset so good that it can't be overpriced and become a bad investment. And very few assets are so bad that they can't be underpriced and be a good investment. HUL was a good asset, but it was overpriced in my view, and while ITC may perhaps be a bad asset as compared to HUL, it was way underpriced than HUL and therefore seemed like a better investment. As I record this, ITC has almost doubled since then. HUL is up only 22%. Therefore, ITC has certainly proved to be a better investment than HUL over the last couple of years. Now, do you know that most stock prices follow the 80-20 principle so famously invented by an Italian named Wilfred Pareto? In investing, the 80-20 principle can be used to describe the stock price movement. You see, 80% of a stock's price movement over a large enough period happens in 20% of the time. I'm sure you would have noticed that a stock that you've held on to for a couple of years will do nothing at first. It will keep moving sideways and then suddenly it will shoot up exponentially in a couple of months. This is the 80-20 principle at work. A stock will do nothing 80% of the time or only cover 20% of its gains. And then in the next 20% of the time, it will just shoot up and cover the remaining 80% of its gains. And I think this is one of the key differentiating points between an investor and a trader. An investor will not try to locate that 20% time block where the stock will record 80% of the gains. He is willing to hold on to the stock for remaining 80% time block if he can earn the full 100% gains. A trader, on the other hand, uses his skills to locate that 20% time block and pocket 80% of the gains in quick time. Which approach is better? Well, the trading approach does seem to be the better approach, as it is all about making the highest possible return in the smallest possible time. However, it is not as easy in practice as it seems in theory, and I personally prefer the approach of an investor over that of a trader. Anyways, as far as ITC is concerned, the gains over the last couple of years have not followed the Pareto principle. They have been more evenly spread, with half the gains coming in the first year and half the gains in the second year. However, the gain in the second year is noteworthy because it has come despite the benchmark index giving flat returns. So while the Sensex has been almost flat for the last 1 year, ITC is up more than 40% and has outperformed by a big margin. More than 40% returns when the benchmark index is flat is very good, to be honest. Now, a big reason the stock is up 40% despite the poor performance of the index is the improvement in ITC's fundamentals. The company has put up a stellar show in the first quarter of the current financial year. It has managed to grow its bottom line by an impressive 38% on the back of a 41% growth in top line. As you can see, all the segments have contributed towards the impressive performance. Agribusiness up 83%, cigarettes up 29%, FMCG others up 20%, paper and packaging up 43%, and hotels, the best performer, up 336%. Therefore, overall the top line is up an impressive 41%. When it comes to profits, again all the divisions have recorded strong growth in profits, led by paper, boards and packaging, where profits were up 56%. Agribusiness profits was up 45%, while cigarettes was up 30%, and hotels business turned profitable from loss making last year. Therefore, if you look at the company's first quarter performance, you will certainly feel that the company has got its mojo back. But But just as one swallow does not a summer make, you cannot predict a company's top line and bottom line based on how it has done in just one quarter. To get a more realistic picture, you have to go back quite a few years, 10 years to be precise. And here's what we get if we go back 10 years. Well, here's what the revenue profile of the company looked like back in FY12. Cigarettes was the biggest segment, accounting for nearly 2/3 of the company's total top line, followed by other FMCG business, agri-business, and paperboards, paper and packaging. We know that the management has been trying hard over the years to reduce its dependence on the cigarettes businesses and increase contribution from other businesses like other FMCG, agri-business and paper. But has it succeeded? Take a look at the pie chart to the right where we have the breakup for FY22. Yes, the company has indeed reduced dependence on cigarettes as far as the top line is concerned. From 64%, the contribution of cigarettes to the company's top line has come down to 40%, a fall of 24%. While the contribution of the agri division and the other FMCG division has gone up by 10 percentage points each. So while cigarette has come down from 64% to 40%, FMCG others has gone up from 15% to 25%, and agri has also gone up from 9% to 19%. There has been a small increase in papers and others as well. Well, so far so good. The company has said that it will reduce its dependence on cigarettes and it has delivered on its promise on the revenue front. However, it is the profitability that has thrown a big challenge for the company. Here is the segment-wise profits or EBIT breakdown for both FY12 and 10 years later, that is FY22. As you can see, the cigarettes business accounted for a lion's share of the profits back in FY12 and it has continued to occupy a lion's share in FY22 as well. So even after 10 years, the cigarette segment contributes to almost 80% of the profits of the company. FMCG others and agri segment, which accounted for almost half of the company's top line in FY22, contributed only 10% to the overall profits of the company in FY22. It is this poor contribution from these two segments, FMCG others, in particular, that had given both the management and the shareholders sleepless nights the last few years. It is one of the big reasons why the company had underperformed for a few years until last year. Now here's the table that really matters. It gives you the CAGR or the compounded annual growth rate in both top line as well as profits between FY12 and FY22 for all the segments of the company. Overall, it does not paint a pretty picture as the top line has grown by around 6%, whereas total EBIT or profits before interest and taxes has grown by a mediocre 9%. The best performer in terms of profit growth has been the FMCG business other than cigarettes, growing at a CAGR of 72% between FY14 and FY22. We had to consider FY14 data and not FY12 because this segment was loss-making in FY12. But since this division accounted for only a small percentage of profit, its contribution in overall profits is also small and is not making a big impact on the overall profits. Therefore, the company's performance both on the top line as well as the bottom line front has been mediocre to say the least over the last 10 years. As I said earlier, while the management has been able to diversify the business model on the top line front, its dependence on the cigarette segment hasn't come down as far as the overall profits are concerned. But is this all going to change going forward? Will the other divisions like agri inputs and FMCG other than cigarettes finally start making contribution at the bottom line level as well? Is the much awaited turnaround finally here? Well, as you can see, even in first quarter FY23, nearly 80% of the profits have come from the cigarettes division. And this despite other segments putting up a great show during the quarter. This means that over the next 2 to 3 years, the fortune of the company would still be dependent on the cigarettes division to a large extent. Now, if we have to figure out how the share price of ITC may perform over the next 2 to 3 years, we need to get a decent grip on the key drivers of returns. You see, the returns that the stock will generate over the next 2 to 3 years will be determined by the profit growth of the company, the expansion or the contraction in the price to earnings multiple, and last but not the least, the dividend that one is likely to earn during the same period. So let's tackle earnings first. We think on a conservative basis, the earnings of the company can grow at 12 to 15% CAGR over the next 2 to 3 years. Although the numbers for first quarter FY23 have been very good, we also need to take into account the growth over the last 10 years and give more weightage to the long-term growth figures than the most recent quarter. We cannot, of course, completely ignore the current quarter growth. Based on the most recent performance and the management commentary, we think the growth over the next few years may come in higher than historical growth rates, and therefore the conclusion that the company could be able to grow its profits by 12 to 15% between FY22 and FY25. Of course, the key is the cigarettes division, which we think should grow between 10% to 12%, as it's a matured industry and cannot grow at a very high rate. The other segments can grow at a fast clip, but since they contribute to the overall profits in only a small way, the overall impact will be limited in my view. So that was all about profits growth. Now what about the PE multiple? Well, courtesy of the strong share price performance recently, the stock trades at a PE multiple that's already higher than its 3-year and 5-year median PE multiple. However, it is trading lower than the 10-year median PE multiple and significantly lower than its highest PE multiple of the last 10 years, which was 45.2x. I think just as in the case of earnings growth, we should give strong weightage to the PE multiple that it has commanded over a 10-year period. This means that the stock could very well trade at a PE multiple of 28 times to 30 times in the near future, which is higher than the multiple it is trading at currently. Also, stocks which show strong earnings momentum also see an expansion in PE multiple, and this could also be one of the reasons for ITC to start commanding still higher multiple than it is trading at currently. If the stock trades at a PE multiple of significantly higher than 30x, that will be an added bonus, but we cannot take that into account currently, as that would amount to speculation and not investing in the strict sense of the term. Last but not the least, the dividend yield of anywhere between 2% to 3% is almost par for the course, as the company has been a good dividend paymaster over the years. Therefore, in addition to the returns one may earn from the stock due to earnings growth and PE expansion, an extra return of 2% to 3% per annum from dividends can also be added in my view. Therefore, in conclusion, the outlook seems to be bright for the stock, and there's a strong chance it may continue to do well in the rest of the year and beyond. However, there are no guarantees in investing, and therefore there are a few downside risks as well. The chief amongst them being a slowdown in the cigarettes business and investors unwilling to award a high PE multiple to the stock because of the whole ethics and morality issues around smoking and the harm it brings to both the smokers as well as the society at large. From a pure number standpoint though, the risk-reward equation still seems to be in favor of the investors at the current price point. Please note that this is no recommendation from our side, and investors are advised to talk to their investment advisor before investing their money in the stock. That's all from me today. Please do not forget to like the video if you found it to be useful. Goodbye and take care.